Perfect. Perfect. All right. So first of all, I hope everyone's doing well. Thank you, Time and Tony, for asking how I am. I'm doing fine. Finally, you guys can hear me too. Yeah. Today I want to talk a little bit about some very important stuff inside the financial markets. And as my first question to you guys, what's the most important event that's been happening this week? Yes, Green Reaper. I will make sure to record it. Yes, the FOMC and the rate cuts, indeed. It's probably the most important event of the month, honestly. And specifically, this one was pretty important because every 4 times a year, the Federal Reserve also includes some more information alongside just a rate cut or rate hold or anything to do with the federal funding rate. They also include some more information about what they are looking at, what they are going to do, what their specifically projections are for the economy, and more. So that's what we're going to look at today, so we can learn how to get a long term perspective just based off one press conference, without even needing to look at a chart, right? So first of all, indeed, the most important news is the Federal Reserve made the adjustment to cut down the Federal Reserve interest rate by 25 base points. So that means we're now at a lower range. And this is the first rate cut we have done in the entire year. So every FOMC up until now, we've just been waiting and nothing has been happening every single time up until now. They finally made a decision to basically lower the interest rates. Right, the last time the Federal Reserve did that was in December 2024, so it's almost a year ago, right? 9 months ago, a little bit more. And with that, they also gave some forward guidance a little bit, right? So uh, this FOMC in September, it's basically the first step into an easing phase. And an easing phase means that they're going to ease down on the interest rate. So basically starting a cycle again of cutting interest rates, because they basically paused the cycle we were in last December when they decided to not cut down rates anymore. So because of their forward guidance that they gave us, there's a balance between elevated inflation and the rising risk to employment. And it's something we've looked at in previous live streams as well, that those two are like opposite of each other, right? And the decision they are making with a rate cut has the opposite effect on inflation and on employment. So that's the hard choice they're facing, right? If inflation rises but employment becomes worse, inflation needs to have a rate hike, and risk to employment sector needs a rate cut. So there's different decisions needing to be made for different outcomes. And what happens if both aren't going well? Well, they're up for a hard decision, and that's what they're looking at right now. They did make the rate cut, but now what we can see is that basically the FOMC, and then I mean the whole committee, is split in their decision. So half of it is basically looking at the elevated inflation, and the other half is saying, no, we need to look at the employment. So they're kind of split in their decision. Time for sure, it will be recorded. So the guidance as of now is very classic, Powell classic, data dependent. It's basically something he says almost every FOMC. We're going to be looking at the data, and we're going to be data dependent. So it's nothing new in that case.
Did we lose your sound again? I don't know if it's just me now.
Okay, should be good, right? Or not?
Yeah, we hear
Okay.
you back. We hear you
Oh,
back.
perfect, perfect. So every 3 months, the Federal Reserve releases a set of projections, basically on the economy, and it's called the Summary of Economic Projections. And basically, this is a forecast that they make, right? Just the way we do it on charts, they make a forecast on different economic indicators. And it's so important to say, these projections are not fixed promises, but they are just to show how policymakers currently expect the economy to evolve, right? So what do they look at in these projections? They make a projection for economic growth, they make a projection for unemployment, for inflation, and for the federal funds rate, right? So you could probably already see it coming as to why this is important, because if they make a projection of what they think the federal funds rate, aka the interest rate, will be in, I don't know, the next 3 years, we'll know what they're looking at, right? And if they say we expect a, let's say I don't know, interest rate of 3% by mid 2026, it means, okay, there's going to be, let's say, 1% of rate cuts coming in between now and mid 2026. So we know how many rate cuts probably are coming, right? So first of all, the first projection we're going to look at, let's see, is going to be the real GDP growth. And this is basically the growth of the entire economy of the US. And the Federal Reserve expects the US economy to keep growing modestly, roughly in line with like its long-term trend of about 1.8 to 2%. Growth is a bit stronger than they expected in June. In June, it wasn't looking very good in the projections, but now they see that it's going better than expected. So it shows that the Federal Reserve doesn't think the economy is sliding to a recession, right? Despite the rate cuts. So they think it's still growing. Usually, when an economy is heading or facing a recession, they will cut rates. So that's why I said despite rate cuts, because they will try to cut the rates in order to accelerate the economy. In this case, they don't think the economy is going to slow down, but they are still cutting rates nonetheless. What you can see here, the green dotted line is basically the estimated normal growth of an economy, so which is about 1.8%. And in this case, we're at 1.6, and they expect the US economy to go to 1.8% and to 1.9%. And after that, they think it might slow down, right? But this can change in the meantime because it's still 3 years ahead. Right on time. Welcome in. Then the other important aspect is the unemployment rate. And unemployment is projected to stay above 4% for the next few years, right? And that's higher than the lows we saw earlier in the cycle, but it's not a sign of crisis. So the Federal Reserve is basically saying the labor market will cool down, but still remain healthy. And the green line here plots basically the natural rate. And the natural rate means that there is a rate of unemployment that the Federal Reserve deems as natural, right? You're never going to have 100% employment in an economy, and they think 4.2% is about like what should be a natural, healthy unemployment level. So they do expect unemployment to go down slightly over time. Then we have the unemployment rate, or I'm sorry, the inflation rate. And basically the inflation rate is still above target, right? This year it's around 3%, but the Federal Reserve expects it to gradually fall down towards the 2.8% goal by 2028. And what we can see is PCE and core PCE. So white line is core PCE and the green one is PCE. Does anyone know what the difference is? Let's see if people know. Yo, exactly, Sharp. Sharp's right on point. Core PCE. So PCE stands for personal consumption expenditures. And core PCE is basically, let's say PCE, right? It's a broad measure of price changes for goods and services, right? And it basically includes everything there is. And core PCE is the exact same index, but it excludes food and energy. So right on for that. Because those categories are usually very volatile month to month, right? So they take them out to give it a kind of cleaner read on underlying inflation trends rather than having those volatile measures inside of it. So that's a bit of a difference between them. And then the most important part that we are going to look at is going to be the interest rates, right? The federal funds rates at the end of the year in percentages. So the Federal Reserve was at a rate of 4.25 to 4.5%. And now they've cut rates with 25 base points. So that means we're now in a range of 4.0% until 4.25. And these projections show us that they expect to cut rates further in 2025 and 2026. Basically, gradually taking the policy rate closer to their longer run estimate of 3% by 2027. The Federal Reserve basically says a 3.0% interest rate is, again, a neutral interest rate that doesn't really slow down the economy, but also doesn't really stimulate at the same time. So that's what they're looking at. Now, why is this important? Well, the Fed's projection matters because they reveal how policymakers themselves see the economy evolving over the next several years, right? And markets will start to price in this kind of stuff, right? So if, let's say, the Federal Reserve expects to be taking multiple rate cuts in the coming months and years, markets will try to adjust and price that in preemptively, right? So let's say there's a big shift in policy and they say, like, let's say something extravagant, and the Fed says we're going to do 10 rate cuts in the next year, for example, which is a lot, of course. We're going to rate cut at every FOMC. People already know upfront that, interest rates are going to be lower. So stuff like bonds isn't going to be, a very high return on interest. So we're going to move our money now instead of later, right? And then what you'll see is that the flow of money starts to move, and money will start to move out of the bond market into risk stocks or risk assets such as stocks, for example, or foreign currencies. And that's how markets price in these rate cuts before they happen. And then when they actually happen, everyone already knew. Everyone was already, adjusted for it. So nothing really happens. And that's something we see sometimes when we have rate cuts or other important stuff, that it doesn't really have a lot of impact, right? Only like on the lower time frame we'll see some volatility, but we don't really see any big trend shifts, and that's because people were already expecting it, and so they already adjusted their positions way beforehand. Now, and why this matters for traders, right? Or the big picture takeaways in this is that the growth outlook is stable. The Fed doesn't see a recession; they just see slower than normal growth, right? And one point is the unemployment edges up slightly. So the job market cools down, but it's not dramatically for now. And they say inflation is taking time. It's still sticky in the long run or in the short run, but they expect it to return to the targets by 2028, basically. Now, we do know that rate cuts are coming, right? Because they expect to keep gradually cutting rates until their policy lands near the 3%, right, by 2028. So we do know that they are going to keep cutting rates. So that's something we can take into account when, let's say, we're looking at at the strength of the dollar, for example, right? So earlier I mentioned, yes, the labor market is kind of unemployment is going up, right, a little bit, and the labor market is a little bit rocky, but at the same time, inflation is also sticky. So what do they have to do, right? They're getting problems from both sides. So what they're doing is, by cutting now, the Fed is basically trying to protect the job market while still keeping an eye on inflation, right? They did a small rate cut, not a big one. I saw some talks online on social media and on websites that they were saying, we expect them to do a 50 BPS rate cut as a surprise. But it's important to understand that they wouldn't just do something just for the sake of having a surprise, right? Because a surprise rate cut, that's the only thing that people do not expect up front. So they're not positioned for it. And that's when real volatility or large-scale volatility will kick in, right? So let's say they would have employed a 50 BPS rate cut. That's what we can expect, a lot more volatility. When is the Fed projection? It was yesterday. Basically, when we have the FOMC statement, let me try to look it up on Forex Factory. You will be able to see it. It says FOMC statement. Let me see. It was yesterday. So it says federal funds rate, which is the interest rate. It says FOMC statement, FOMC press conference, and sometimes it will also say FOMC economic projections. And when you see that, you know they'll basically give up their thoughts about what they expect to happen in the market. And it's like I think it's a 20-page document, something around that. And with that, they will release the FOMC statement. And in the FOMC statement, they basically explain their decision. Why did they cut the rates, or why did they hold? And then in page 2 of the statement, they will tell you what they're going to be looking at in the near future. Did Trump fire Powell? I don't think so. I don't think Powell was fired. Or did I miss something? Yeah, I don't think there has been anyone fired. Yeah, Trump doesn't have the ability to fire. Yeah. And the funny thing is, Trump himself is the one that hired Powell in the first place in his first term in 2016. Well, I don't know if it was 2016, but in his first term, Trump appointed him as the leader of the Federal Reserve, indeed. And now he wants him gone. Talking about and then ask whoever appointed Powell. Yeah, that happened also. Yeah. Talk about going full circle, right? So now you might ask yourself, why is this important for traders, right? Well, let's say you're an equity trader, right? You trade US indices. Well, if we know that a gradual easing cycle is coming up, it usually tends to support stocks, right? But at the same time, very sticky inflation can cap rallies, right? Because if inflation stays sticky or stays coming up or it doesn't go down, it will increase the likelihood of the Federal Reserve pausing their easing cycle, right? Which makes people less bullish, so to say. Let's say you're a Forex trader, right? A lower rate path usually will weaken the dollar, right? So if people already know up front that the dollar is going to be having less return on interest on the bonds and stuff in 1 or 2 years, people will start to take out their money slowly but surely and put it into higher return on interest assets, right? So that's basically what fuels risk on and risk off scenarios. So these rate cutting cycles basically fuel risk on cycles, right? Or risk on scenarios, basically. So at the same time, we still have the inflation stuff that happens, right? So the inflation risk keeps two-way volatility alive, basically. So we could still expect both sides. So basically, these projections, they give you a framework to shape bias on a long term, right? And if we already have a narrative and a bias on the long term, all that's left is for us to, as traders or technical analysts, to look for the signs that the technical part is aligning with it, right? What's my view on the market? Is it just going to keep on pumping? Well, that's up to... Yeah, nobody can predict it. Yeah, exactly. It's usually the fundamentals will support a certain narrative, and then we'll have to look if the technicals support that too. If they are in agreement, it's usually a higher conviction. If they are not, it can signal different stuff. But at this moment, fundamentals haven't changed and haven't changed to bearish on fundamentals. There's no reason for fundamentals or for indices to go down fundamentally, right? Unless we have some different data coming in. So I'd say, how could you measure this from now on is to keep your eyes very close on anything that has to do with the labor data, so the job market, any news release that's coming up, and also all the inflation news. Those two are going to be the most important ones, right? Because the Federal Reserve tells you that those are the two things they're going to look at, those will most likely also be the most volatile news events, right? So it's also at the same time, it helps you protect your risk in intraday trading, because if you understand that something simple as consumer confidence is not something they're looking at, it's most likely not going to be as volatile compared to anything that has to do with the labor market or with the inflation percentages, right? Because those two will now directly influence the decision making of the Federal Reserve. So basically, it's a roadmap of basically what the Federal Reserve is thinking. So that's what we look at with this. Thoughts on DXY minus 12.5% on year to date and rotation into bonds while indices are also increasing. And rotation into... No, you're not late. Welcome in. Rotation into bonds, you mean as in bonds are going up? Because the DXY going down was pretty much expected on my part. Let's see. If I will... So yeah, the yields have been going down. Let me grab DB. And bonds have indeed been going up. At least the bond prices have been going up. So usually what we'll see is that the yields and the dollar index will move the same, right? So we'll see that while the dollar falls down, usually the yields will also, or when the yields fall down, the dollar will follow and also go down. So it makes sense that if the dollar goes down, that the bond prices increase. Give me 1 second. I gotta kick my cat out of my room.
I know all about that. If you ever had a cat go and crawl on your desk just because he wants to get pet, that is definitely a real thing.
No, she's trying to bite my cables, and I do like
That's
my
even
cables,
worse.
so yeah, that's real time footage, by the way. You just came from a webinar, and she didn't want to ask some of your questions. What were your questions, though? Your cat's the killer of cables, aren't they all? Whenever they don't get attention for like 2 seconds, they're like, okay, sure, then I'll bite your cable. Yeah, cats can be incredibly sweet, but at the same time very devious. Yo, why does this guy have half the picture of my cat? Let's see if there's some questions in, by the way, because we basically covered all there is about this current FOMC meeting we had yesterday. What are some important timings for me? As in intraday, I'd say 8:30 because of the news embargo lifting, and 9:30 when the stock market's open. Those are the most important for me. And then after that, so let's say those are S tier, and an A tier would be 4-hour candle openings probably. So 6 a.m. and 10 a.m. US have to pay a lot of that. Yeah, $36 trillion. That's true. They have a big debt at this moment. What about 3 a.m.? I don't really trade London, so I don't really look at 3 a.m. honestly. Do I use the US dollar as a correlation? Yes, when trading currency markets for sure. Yeah. How are they gonna do it unless no one is buying their bonds? Good question. Let's see. Trading NQ, what do you use this into? Yeah, probably only ES and YM. Yeah. I don't really use the dollar index a lot with NQ. Just because they're not entirely correlated. Because there's also periods where the dollar can go up. Let's say it can become more valuable, but at the same time, let's say the Nasdaq can become even more valuable than the rate at which the dollar is getting more valuable. So they'll both move up, right? And it's not necessarily that they're moving out of sync. It's just that the one is just getting more valuable than at a faster rate than the other, right? So it's a good question, Abdul. So the federal or the U.S. basically is in debt to multiple parties, right? So it's going to be, for example, U.S. investors, foreign investors, and the Federal Reserve. It's also in debt to the Federal Reserve. Yeah, usually the thought is that the US dollar is moving inverse of NQ because the thought is that whenever the dollar devalues, um, NQ will become more valuable in dollars, right? Let's say NQ has the same value, but because the dollar itself devalues, NQ will go up because it's more worth more dollars at that point. Do I clean the kitchen after cooking? No, I leave it for you. She said that tactic is in upcoming season of FOMC, reduce the rate till 0% and buy back themselves. So it's reason to print money. Yeah, that's a common thought, indeed, that they will kind of restructure the debt that way. Well, have a nice day, Alex. Hope you're doing well, and we'll see you at the next one. Have I ever heard of The Creature from Jekyll Island? No, I haven't. It's a great book. What's the book about? Is it a fiction book? I'll add it to my list. The Creature of from Jekyll Island. Is that the coast evasion of Federal Reserve? Ah, okay. That should be interesting. The origin story. Yeah. It's very interesting the origin of the Federal Reserve and how that worked. Yeah, exactly. It was back in the day. Way back. So if the rate is low, assets grow more again. Yeah, so basically what happens is if interest rates are low, right? It makes less sense to save because you're not getting a lot of money back for giving your money to a bank, for example, right? So it makes more sense to seek value or return on interest somewhere else that would give you more, right? So on a big scale, what will happen is that people will start to take their money from low yielding assets and put it into higher yielding assets, right? So they'll be willing to risk more at that point. So we have a risk on situation and money will start to flow into the economy, right? It will start to people will start to spend more, basically. If it, let's say in Europe we've had negative interest rates before. Before this rate hiking cycle that we had around COVID, we had negative interest. So basically, you had to pay to save, and it was like, yeah, like current. No, Japan is in positive now, but it was like minus 0.25 for like 6 years or something. So back then, it didn't really make sense to to save, right? Because you're going to be paying to save, so you might as well spend it, right? So what people did was spend more and more and more, and that basically fuels the economy, and therefore stock markets will slowly start to rise as well, and every other risk asset. And that's what we saw with the stock market making all-time high after all-time high, and cryptos going for all-time highs, and basically everything, right? It's basically a game of understanding where money will flow towards in which situation, right? And the interest rates is just a gas pedal slash brake pedal on a economy. Let's see if we have some more questions. Let's see. What am I expecting from the Fed? Well, basically, um, we should all be expecting the same thing because they tell us what they're looking at, right? So you might have to wait for the recording, but I basically went through what the Fed is expecting, and we can basically keep our eye on that and check the data to see if it aligns with their expectation or not. If it doesn't, we know that they'll react differently, or maybe they'll change their expectation and they will tell us in the next FOMC. What's up, Mo PTT? What's up? Hope all is well. Um, I journaled immediately, right when I'm inside a trade and after. So in my journal, I have something that documents like trading psychology, for example, and my mental state. So I do it during and after. If I would have to do it all after the day, it would probably bring me a big headache because it's a lot of stuff that I have to record. So I do it during, just because I know I'm living it at that moment, so I can basically document um, my mental state and everything around that much more accurately. What's my average trade in terms of handles or ticks? Honestly, I don't know what the average is. I don't really look at handling a specific amount of ticks or handles or pips or whatever. Some people actively look for a certain amount of handles in a trade, but I don't. So I don't know the exact average. Do you agree that these events as isolated catalysts as part of a broader continuum of liquidity cycles, Asia, London, New York, as in the news merely injects energy into? What are you referring to exactly? Could you rephrase the question? And with events, you mean news events or? How to place targets on all-time highs without standard deviations? Good question. Something useful that I usually use is looking for round numbers. Usually, markets will, gravitate towards specific round numbers such as I don't know, 250, 500, 750, and other round numbers. What's up, default? Good to see you here. Okay, so that's a good question. Do I perceive these major news events as isolated catalysts in themselves, or do you see them as amplifiers within the broader continuum of liquidity cycles, like Asia, London, and New York, where the news doesn't create direction but rather injects energy into an already unfolding delivery? Basically, how I view it is this, right? It all starts top down. Well, it's a top down approach, right? It all starts at the top with large players wanting to enter a market based on a long term view, right? So let's say we have a large institution that wants to place an order that's really big because they expect the market to go to, go lower or higher over a certain amount of months, weeks, or whatever it is, right? They can't just press a button and enter their entire um, position at once because it doesn't work. They'll shake up the market and they'll get filled pretty badly because there's not enough counterparty for their trade, right? Whenever you open a trade, there's always a need for someone on the other side. So that's where these market algorithms that we know come in, and they'll actively seek participants to be able to fill those orders, right? And whenever let's say we hit a liquidity pool, that's where they'll look to find counterparties for these large orders, right? And if the order hasn't been filled yet and they need more, that's when you see the market will start to dig deeper and deeper and deeper into a liquidity pool, because that's where more and more participants become willing to enter a trade, right? And that's how, over a large cycle, which is usually seen by us as market maker models, a large position is filled, right? And whenever we have news coming in, that kind of adds more fuel sometimes because it could support their idea, right? It could support their idea of what the market's going to be doing, because those data points from news events will either be how can I say, in support of their idea, or will be against it, right? I can try to draw it out on TradingView. Give me a second. We'll open up a chart. Okay. Let me switch my screen real quickly. Okay, so let's say our friend Papichulo here wants to buy 1 million, or let's say we're looking at a forex market, right? And our friend here wants to buy 10 billion USD, right? How can he buy 10 billion USD? There need to be other people that are willing to sell 10 billion USD, right? So let's say our friend here says, let's go to Euro USD, right? And we'll go to a daily chart, clean it up, right? Let's say our friend here wants to buy 1 billion USD, but he wants it at a certain price, right? He'll say, I won't pay more than 1 euros and 10 cents per dollar, right? Or other way around. Because it's a euro against the dollar. Let's say we have that price line right here, 1.10. So it sets a limit order for this, right, at his bank. And once the market comes to this level, his order will start to activate, right? And they'll be looking for participants that are willing to sell at 110, right? So he can buy at 110. But maybe there's only, let's say, at this level, there's 6 billion available, right? His order might get partially filled. So what will happen next? How would they find more counterparties, right? They'll be like, okay, we need to go deeper, right? A market maker will start to basically, market maker supplies both sides of the market, right? But once all these orders have been absorbed, right? Because there's nothing left on this level, like at this point, right? Which is 110, because all 6 billion sellers have been absorbed by his buy order, right? what's going to happen next is the market is going to fall down, right? Because there's nothing left to transact that, right? So it will start to slowly go down and down and down more to absorb more sellers because there's one big buy order from our friend Papi Chulo here, right? So we'll start to dig deeper into a liquidity pool all the way until this $10 billion order has been filled up, right? And that's how we can basically see, or how we witness, markets going for liquidity pools, right? And it's nothing like that's kind of the thing that I look differently at in compared to a lot of people in this space, that they'll basically frame it as the evil market maker going after your stop losses, right? And in my opinion, that's not the case at all. They're not doing stuff on purpose to hurt people. It's just the market naturally gravitating towards places because otherwise there's no counterparty. In order to fill specific orders, which are very, very large, they need counterparty. And where are you going to find counterparty traders that are willing to be on the other side of the trade? It's going to be at specific places where there's a lot of concentrated liquidity. How do I confirm if those orders have been filled? You don't know. We don't know. It's just something that we analyze and we think is happening, right? We don't actually know if our friend Papachulo is, actively buying stuff in a forex market, and I'm talking about a spot forex market, right? We can't see in futures markets. However, you can see through the footprint charts, right? Because forex markets are indeed OTC, so it's over the counter, which could mean, for example, Bank A and Bank B, they do transactions, and we have no clue, right? We don't know. All right, so that's how it works with like seeking counterparty in the trade, right? Because at, let's say, eventually over this this price range, we have filled the other 4 billion, right? Fine. Now you have the $10 billion trade is filled up and is filled, right? And now it could be that at this point there's no more buyers left, right? So anyone that's willing to sell at this level, who's gonna buy? No one, right? So what's gonna happen? It's gonna do nothing. It's not gonna go deeper because at this point the order has already been filled. So there's no interest anymore at this point in the market. But because this stuff is basically the way this stuff is done and the way those orders are, those large, crazy large orders are filled, is done in an efficient way, right? To make sure those orders aren't basically messing up the markets, right? And that's why we see those recurring, I don't want to call it patterns, but recurring patterns basically in the markets, right? Which translates to market maker models, is how we view them, right? It's basically how large parties are efficiently positioning themselves inside a market, right? So in my opinion, it has nothing to do with Mr. Evil Market Maker hunting all our stops and wanting us to lose, but it's more like the market has to do it because it needs to deliver efficiently and needs to fill orders. What's up, Poison? Hope all is well. And then let's say what happens when the market displaces in one side, right? We have a very one-sided move. Well, basically, at certain price ranges, there will still be orders left, right? Because they couldn't get filled. So what happens is the market will then basically retrace into those imbalanced areas, and that's where we'll look to pair those orders that have been left behind. And that's what we see as stuff like fair value gaps and sell side imbalance, or SIBIs and BISIs and that kind of stuff. Wouldn't big money use their own previous positions to pair order or mitigate their previous positions in order to induce more liquidity for their benefit? In what sense do you mean that? Do you mean like they would I don't know what you can mean with their own previous positions. Because if they are previous positions in my eyes, they're closed already, right? So they don't have those positions at that point. Because it's all about finding willing participants. And if there are no willing participants at a specific price range or price level, the market will just keep going until it can find those. Exactly. Use the fractal consolidation tool. That's the best way to do it. Let me just look back to time frame look back, and then we'll do 12 months. Bang. This is how we'll help you train your eyes. Honestly, does it might be an interesting topic to go into in another stream, how this kind of stuff works on the deeper level, how large parties scale into trades, how they open trades, how basically the market works on the back end for that. Might be an interesting topic. What's up, Slim? How are we doing? So, Time, you mean, let's say they have a big sell order ready, or they have a big sell position. Um, but at the same time, they are looking to buy. Is that how you mean it? I don't hear music as well. No music. Oh, it's maybe the lobby music or something. Yeah, it's the lobby music. Yeah, you can turn it off through the button there. Let's see. Do we have any other questions? Or otherwise, we'll start to round up the stream slowly but surely. Ooh, small giveaway. Well, large players sometimes hold one side of the. Well, they do have positions open on both sides of a market because they are hedging, right? They might be, um, let's say, bullish on a dollar, but at the same time, they're gonna hedge the risk of being bullish on a dollar by being short on other assets that are dollar denominated, right? So they might short dollars on other assets to make sure to hedge their risk. So that does happen. Those are some good odds for sure. Practical consolidation is definitely top 5 indicator. Definitely. Maybe even top 3. Top 3 easy and it's not third. So it's top 2. basically. Do a few of
Yeah,
them
if you want to enter the
as...
giveaway, all you gotta
Yes.
do is hit that party emoji and you will be entered. So yeah, we'll give away Fractal Consolidations, the tool, and you got pretty good odds, honestly, if you were to look at it. And there'll be 2 winners for 1 month of access. So
Pretty good odds.
if you would like to try out the tool and you want to enter the giveaway, even if you have, another subscription, that's fine. And hit the party emoji. So yeah, we got you guys.
So Josh, this question from Time, I like that. He says he asked, "Do you view them as single sparks, as referring to news events, or part of a long-term choreography where each event sets the stage for the next, mapping a broader concept of how liquidity is delivered?" I'd say I lean more to the second one, and I think you, Josh, did a little bit of a case study or backtest on that on stream months ago, if I recall correctly.
Yeah, so let me
That was a
that's it's kind
fire
of
one,
an
but it was like a random stream, like I don't know, more than half a year ago, I think.
Yeah. So basically, we're dissecting the monthly range
Yeah,
based off of the news events, and that was really a good stream, honestly. I do remember that. But yeah, definitely take a look at how the calendar is basically an influence to the monthly range. And you'll start to notice, repeating patterns of specific news events and what they mean for weekly profiles. So, for instance, again, it's for your own back testing, obviously, but most people will understand this because it's just the clear one. But it's like CPI is a very volatile event, and it happens in the middle of the month, right? And that's typically an expansion day, right? It's rare that you'll have a reversal, but they still happen, and those profiles can also be studied. And there's also a bunch of different news events that are in the month that you can just be aware of, and just being aware of them will also help, let's call it, tame specific expectations that you may or may not want to put on the market, right? So it's like most people, again, when they see a very large candle up, again, Tom Haggard basically talks about this in his book, but it's basically the supermarket mentality. It's from The Best Loser Wins, that book. And basically, there's a lot of, let's call it, beginner traders, and I've fell victim to this, and that's the only reason why I'm even, bringing it up. But when you used to have, very large candles or very, one direction trend days, most people, again, will, find reasons, outside, whether it's on the chart, technical, or, fundamentally, that they say something, or, it might be just some kind of, like, let's call it, feeling, or, irk, that they want to just sell short on a very large trend day up. And, ultimately that's a very dangerous thing. And to kind of basically show you what happened today, you can basically see it that as well. Obviously, there's going to be short, let's call it, retracements that are going to happen during a large trend day, but that is not something that is, let's call it, conducive for long-term success. And, obviously there's going to be some times where a trend day will turn into a reversal, but those are going to be very, very, let's call it, small probabilities. So that's just one example that you can kind of see, and tame specific market profiles around specific news events. And that's something that's very, very powerful because it gives you a lot more clarity in how you want to view that specific day or week or even monthly area. And again, just because we're talking about like monthly ranges and all that stuff, obviously, once you get towards the end of the month, that's when you're going to also start to see a lot of decoupling, come into play. Some monthly candles are going to be setting their wicks. Some monthly candles are going to be, looking to expand away if they've consolidated in the previous, last 2 weeks. So there's a bunch of different things that you guys can study relative to the monthly range, and hopefully that's insightful. So Tony and Abdul, shout out to you guys.
congratulations.
Congrats. Yeah, Abdul, you won. Tony, you can pick someone if you want to give it back to the community. If they're inside this chat, you can nominate someone if you would. I can do another rerun, but that's gonna just take a little bit more
Watch
time.
him auction it off.
Yeah. But Tony, I appreciate that. That means a lot. I like that. Good number. Shout out to you. All right, Poppy Chulo, you can create a ticket. We'll get you hooked up. Way to be on top of it. So Bobby Chulo and Abdul, you guys can try out the indicator. Everybody that's been here so far, I really appreciate it. If you guys have any other like just questions, I'm always happy to answer. We recently, opened up the elite chat inside of the Discord, and I was really waiting for rollover week to kind of take into effect. For you guys that don't know what that is, rollover, it's basically when the contract changes for index markets, and it also for any other like specific futures, but specifically index futures is what I trade. And it'll tend to be a little bit more, let's call it choppy and less, um, let's call it less, how do I use the word? How do we say this? I don't want to say predictable, but it's just less clean for your actual full anticipations, right? So like there's something called, again, like split volume, right? And during Monday and Tuesday, there's going to be a lot of, funds that basically start to have specific arbitrage, bots that go on, and they basically look for price disparities between the two contracts. And there's also people that are spread traders, which is a whole nother, topic of discussion. But some people will basically buy 1 month and sell the other contract month, and then they'll make the money off of the difference. And they go in and out of positions. And you also sometimes have, and this is the one that really annoys me, during contract rollover, you'll have a lot more occurrences of NQ and MNQ having very small price disparities. I predominantly trade MNQ, so when I chart on NQ as my main asset, sometimes that'll mess with some fills and or look at, certain liquidity pools that have already been taken out. So there's a couple of nuances that are during contract rollover week that I personally like to just be aware of, and those are some of them. Um, ICT actually just released a nice video as well on his Twitter where he talked about utilizing the previous contract, um, basically inefficiencies, and how some of those will get rebalanced as well. And that's something that you guys can study as well. So that was pretty cool. But yeah, all in all, there's a lot of volatility this week, specifically because contract rollover, occurred during a time of FOMC. I don't really recall how many times that's probably happened in the past. Um, but yeah, that's why you'll see a little bit more volatility this week. But typically, if there's not a, crazy news event and or, a Fed decision, then your Monday, Tuesday, Wednesday price action is going to be a little bit more muted and just harder to trust overall. So. But we'll be in there next week on the Elite chat. I look forward to chatting with other people that have the Elite collection, and we'll be able to share some charts, talk with Morris about some gems, and yeah. If you guys found this insightful, or if you have any other questions, then please let me know. I appreciate it. I know Sign of Time definitely appreciates it as well
Yep.
for everybody that contributes. And yeah, we'll probably end the stream soon unless there's any pending questions.
Let's see if there are any.
Thank you, Tony.
Appreciate it, Tony and Time. Appreciate it. And Sonic also.
So yeah, we will look to end it here. If you guys have any further questions, you know that you could always ask inside of the general chat or indices, or if you have the elite collection, pop into the elite chat. You could tag me and I'll look to be able to be there mostly next week.
Yes. Have a great time, everyone. And I'll see you guys next week.
All right, take it easy, everybody. Bye bye.